Interest rates explained and how they affect you. Why do interest rates matter so much? Every time the news says the Fed or your central bank is raising or cutting rates, markets move, mortgage shifts, and your savings account changes. But what exactly are interest rates and why are they so powerful? In this video, I'll break down how interest rates work, why governments change them, and most importantly, how they affect you. First and foremost, what are interest rates? Let's keep it simple. An interest rate is basically the cost of borrowing money. If you borrow $1,000 from a bank with a 5% interest rate, you'll owe $1,050 after 1 year. On the flip side, if you deposit money in a savings account, that same interest rate determines how much the bank pays you. But here's the key. When we talk about the interest rate in the news, it usually means the central bank rate, the rate they charge commercial banks to borrow money. That one number ripples through the entire financial system. So why do central banks change rates? Central banks adjust rates to keep the economy balanced. And it's a very fine act. When inflation is high, they will raise rates, borrowing gets more expensive, people and businesses spend less, and demand cools down, which brings prices back under control. When the economy is weak, the lower rates, borrowing gets cheaper, businesses invest more, people buy houses or cars, and spending rises, which then in turn stimulates growth. Again, it's a balancing act. Too low for too long and you risk bubbles. Too high for too long and you risk recession. So how does this affect you and what's the relevance? Here's where it hits home. Mortgage and loans. Higher rates means bigger monthly payments on your mortgage, car loans, credit cards. Lower rates make borrowing easier. Savings and investments, higher rates usually mean banks pay you more on your deposit, although it's not usually as high as the rates that you will see from the central banks, but they can also pull money out of stocks and bonds, shifting markets, because at the end of the day, if you've got money in the bank, there's no risk, right? So why take risk being exposed to the stock market when you can get a good solid rate from the bank? And then you've got jobs and wages. If businesses face higher borrowing costs, they might delay hiring or expansion. When rates are lower, growth and hiring tends to pick up. So whether you're an investor, a homeowner, or just someone with a credit card, interest rates play a direct role in your financial life. So interest rates aren't just numbers in an economic report. They are like levers that the central banks pull to steer the economy. They affect your debt, your savings, your job, and your future investments. So next time you hear about a rate hike or a cut, you'll know exactly why it matters. If you found this breakdown helpful, hopefully you did, make sure to hit the like, hit the subscribe for more clear explanations on money, markets, and drop a comment or drop us an email at info@expatmoneychat. And share, do you think rates should stay higher to fight inflation or lower to support growth? So, thank you for watching as always. Cheers.